Hello everybody, welcome back to my channel where we talk all things finance and investing. In today's video, I'm going to do a bit of a deep dive into the recent FactSet article on the upcoming US earnings season. I think this earnings season is going to be absolutely crucial for the stock market for 2025 and should give us a lot of insights on what we can expect for the year ahead in the stock market. It's been a great 2 years, up 20%. Each of the last 2 years, not something that happens very often. So it's very critical this year to see what's going to go on with earnings. Earnings ultimately drive stock prices and therefore the stock market itself. So let's get into the video, deep dive, FactSet insights on Q4 earnings reports coming up and outlook for 2025 earnings. So before we get into the video and the report itself, I think it's worth highlighting exactly what earnings season is for anyone who's not aware. So every quarter, US companies are required to publish and make public their earnings for the previous quarter. And they'll go through and give all sorts of information. I've done a video on this on Nvidia. I'll put a link in the description on that where we break down their actual report itself. Really useful to know. And this is a great chance for outside investors to get an idea how well the company is performing. Transparency is key when it comes to stocks in the stock market. And quarterly earnings are the best way to do that. So it's definitely worth keeping an eye on not only their earnings itself, but also what their guidance is or what their estimates are for the upcoming quarter. It's just as important. But this is a great chance for investors to really deep dive into the books of the companies that they're investing in and get an idea whether they want to buy more, sell more shares, or what's actually going on. Earnings drive stock prices for the most part. And earnings season is the best time to get an idea what those earnings look like. Now let's get into the report. Okay, so on my screen here, we have the report by FactSet. As you can see on the top right corner, it's the earnings insight. John Butters, a vice president, senior earnings analyst, did the report and it was published on January 3rd, 2025. So just come out just a couple of days ago, actually. So let's get into it. What to expect for the earnings season coming up for Q4 2024, which will be reported here in January starting next week. So a couple of highlights I made after going through this. So first off, we have for Q4 2024, the estimated year-over-year earnings growth rate for the S&P 500 is 11.9%. If 11.9% is the actual growth rate for the quarter, it'll mark the highest year-over-year earnings growth reported by the index since Q4 2021. So there you have it. So 11.9% expected for the quarter being fourth quarter 2024. That is a very strong number if it comes through. Earnings revisions, this is important, okay? On September 30th, the estimated year-over-year earnings growth rate for the S&P 500 for Q4 was 14.5. So at the beginning of the fourth quarter, expectations were for 14.5. Now it's come down to 11.9. Why? Because some companies have revised their earnings down. So what a company does when they go into the quarter, they'll give an estimate for their earnings per share, okay? And then they'll see some numbers come in through the weeks and the months, early part of the quarter. And if those numbers are showing to be a little bit softer than originally expected at the beginning of the quarter, they can make an earnings release or an update to that estimate or give some guidance, sometimes positive, sometimes negative. So in that case, we've seen some more negative earnings revisions, okay, or guidance, as you would say. For Q4 2024, 71 S&P 500 companies have issued negative EPS guidance and 35 S&P 500 companies have issued positive guidance. So the ones that have come out mid-quarter to give some update to their guidance, the majority were actually to the negative. So that suggests that maybe some companies are having a weaker or had a weaker fourth quarter than they originally expected. Okay, and then in terms of valuation, the forward 12-month PE ratio for the S&P 500 is 21.4, which is above the 5-year average of 19.7. So PE ratio is just the price to earnings ratio. So if you take the earnings per share of the full S&P 500 and you multiply it by 21.4, you would get the actual index number of around 5,900 at the time of this recording. So the higher that number, the more expensive or the more highly valued the index is. And 21.4 is above the 5-year average of 19.7. 0.7. So right now, the S&P 500 is slightly more highly valued than it was over the last 5 years. This isn't particularly new. If we look at this chart here by FactSet, the S&P 500 earnings growth year on year for Q4. So as we can see right now, it's at 11.9% expected for the quarter, but it started in September at 14.5%. So the revenue growth, the earnings growth for the fourth quarter has come down compared to what people were expecting back in September. Okay, a couple other bits and pieces to go through. So first off, more S&P 500 companies issuing negative guidance, which we just saw. As a result, the percentage companies issuing negative EPS guidance is 67%, which is 71 of the 106 companies that came out and gave that updated guidance, which is above the 5-year average of 57% and above the 10-year average of 62%. Okay, so that puts it into context, gives us a little bit of a benchmark. When companies are coming out and giving some more negative guidance, we can see 67% is actually higher than the 5 and the 10-year average. So what are we seeing here? Well, we're seeing some more companies come out with negative guidance than we have seen in the past. So that would give us an early indication that perhaps the earnings, when they come through in January, may not be as strong as expected. If we dive a little deeper here into the sectors, at the sector level, the IT, information technology, industrials, consumer discretionary sectors have the highest number of companies issuing negative EPS guidance of all 11 sectors. That's interesting. I would have thought information technology in particular would be the opposite, but it looks like those sectors in particular have been issuing some negative guidance for Q4, which is not particularly good news. Nothing to panic about, absolutely, but definitely some stuff to be aware of. Okay, so we'll keep going down here into my next set of highlights. So topic 2, how much did analysts cut the earnings per share estimates for the S&P 500 for Q4? Well, the bottom up earnings per share estimate, what do they mean by bottom up and top down? Well, bottom up is when an analyst will go in and look at the micro of a particular company based on their sales, their profit margins and everything, how much they earn, and go from there. Whereas the top down might look at the overall economy, GDP growth, sector growth, and how that will come down to affect a company's earnings. So for the purposes of this report, it's more of a bottom-up earnings per share estimate, looking into the micro of the particular company and working up from there. So the Q4 bottom-up EPS estimate, which is an aggregation of the median EPS estimates for Q4, EPS just earnings per share, for all the companies in the index, decreased by 2.7% to $61.88 from $63.60 from September 30th to December 31st. The percentage is smaller than the 5-year average. Okay, so earnings estimates overall have come down from September 30th to December 31st. Not a particularly bullish sign, but nothing to panic about. This one here, the calendar year 2025 bottom-up EPS estimate declined by 0.9% to $274 from $276 from September 30th to December 31st. So for calendar year 25, and this is our first kind of indication for next year for 2025, the earnings per share estimate declined by 0.9%. That's not a particularly big amount, I don't think, to go from an estimate of $276 per share to $274 per share. To me, not a big deal really, but notice it wasn't a revision to the upside, it was a revision to the downside. But this gives us an indication for 2025. If the earnings per share for the S&P 500 in 2025 is $274, well, if you give that a multiple of 22 times, then if you kind of multiply 274 by 22, then you're going to be up at around 6,000, which is around where the index is right now. And an increase up from 2024, as we'll see later, in terms of earnings per share. Okay, so that's our first little bit of a sneak peek into 2025. Okay, let's get into the numbers a little bit further here. So estimated earnings for the S&P 500 in the fourth quarter are lower today compared to expectations at the start of the quarter. Despite the decline in estimated earnings, the index is still expected to report its highest year-over-year growth rate for the fourth quarter in 3 years. That's great news. The expectation is that the fourth quarter earnings will be the best that we've had in 3 years' time. Let's hope that that's the case. On a per share basis, estimated earnings for the fourth quarter decreased 2.7, so it did come down through the quarter as we just saw. At this point in time, 106 companies in the index have issued EPS guidance for fourth quarter 2024. Of these companies, 71 have issued negative guidance and 35 has been positive. Okay, we saw that a moment ago. There's been more negative guidance as opposed to positive. As of today, the S&P 500 is expected to report earnings growth of 11.9% compared to the estimated year-on-year earnings growth rate of 14.5. 11.9, let's call it 12%, is still a very strong earnings growth rate in a quarter. So that would be great news if that was the case. If the 11.9 is the actual growth rate for the quarter, it will mark the highest year-over-year earnings growth rate reported by the index since the fourth quarter of 2021, which was a staggering 31%. If you remember, the stock market, the S&P 500, had a fantastic year in 2021 before selling off in 2022. So 11.9% earnings growth in the fourth quarter alone would be very strong indeed. Let's get into the sectors. 6 of the 7 sectors are predicted to report double-digit growth numbers. Financials, communication services, IT, consumer discretionary, utilities, and healthcare. Only one is going to report a double-digit decline, and that's energy. So energy not looking good at all for the fourth quarter earnings, whereas these ones, financials, communication services, IT, looking to be much stronger, double-digit growth in EPS. Not massively surprising that IT is in there, to be fair. Communication services as well. Financials a little bit surprising for me, and utilities and healthcare. Was not expecting a double-digit growth rate in earnings per share for those sectors. Okay. As of today, the S&P 500 is expected to report year-over-year revenue growth of 4.6. So now, as opposed to earnings, which we've been talking about pretty much throughout this video, now talking about revenue growth, just sales growth, 4.6%, compared to expectations of 5.2. I find that revenue growth figure 4.6 on the low side, to be fair, and it has come down from the 5.2, but not by a big amount. 8 sectors are projected to report year-over-year growth in revenue, led by the IT sector. This cannot be a surprise. When you see the likes of Nvidia, Apple, Microsoft, Alphabet, Meta, all of these companies, particularly in the hardware, semi-space, everything that we've seen with AI spending and investment by these companies, it's not massively surprising that IT will be leading revenue growth, as they have done for a while now. Now, I've marked this one in green because I think it's really, really worth noting. For the calendar year 2024, analysts expect year-over-year earnings growth of 9.5%. The S&P 500 tends to compound on a long-term basis right around 10%, just a little under 9.8, I believe. So here you see the earnings growth rate of 9.5, and earnings growth is what actually impacts company profits and therefore share prices. So if you can see earnings growing at 9.5%, you could well expect the stock market to grow by around the same amount. Of course, there's human behavior, there's emotions, there's all sorts of things involved. So you'll get extremes up and you'll get extremes down. But overall, it should revert to the mean, and the stock market should grow in line with earnings reported by companies and their earnings growth rates. For 2025, analysts are predicting year-over-year earnings growth of 14.8%. Yes. 14.8%. So 2024 expected around 10 and 2025 expected around 15. So that's a 5% increase in earnings per share for 2025 expected. All else being equal, then, we could expect 2025 to be a good year for the stock market, despite having 2 years of 20% plus. So that is a really interesting part of this report for me, for sure. Expectation of around 15% earnings per share growth for 2025. Okay, going back to earnings revisions. Okay, energy, I mentioned earlier, double-digit drop in expectations. ExxonMobil and Chevron leading the decrease. Communication services, Alphabet and Meta, Google, Facebook, let's say, lead the earnings increase since September 30th. So the communication services sector has recorded the largest percentage increase in estimated, being dollar level, Earnings of all 11 sectors since the start of the quarter at 3.1%. It looks like communication services still going strong. As a result, the estimated year-over-year earnings growth rate for this sector has increased to 20% today from 17%. There you have it. So if you wonder why the media bangs on about Mag 7, we've got concentration in the S&P 500 at 100-year highs, right? And the Mag 7 doing so well in the stock market, growing their earnings. Here you go. The reason for that is they're growing their earnings at, in these cases, 20%. So therefore, it's normal that their share prices are going to outperform and they will have a higher kind of weighting in the S&P 500. But the fact is that they're growing their earnings so much. Fantastic stuff by them. Okay. Quarterly guidance negative. At this point in time, 106 companies of the index have issued earnings per share guidance for the fourth quarter, and 106 of the 106, 71 have issued negative and 35 positive. So much more of a bias towards the negative and updated earnings. The number of companies issuing these negative EPS guidance for 2024, or for the fourth quarter 2024, is above the 5-year average of 56 and the 10-year average of 62. This is a negative sentiment. Again, nothing to worry about too much, but we have seen more companies come forward with a negative guidance for the fourth quarter than we've seen. Earnings growth of 11.9, as we saw earlier. The estimated year-over-year earnings growth rate for the fourth quarter is 11.9%. Let's call it 12, which is above the 5-year average earnings growth rate of 10.4 and above the 10-year average of 11.5. So therefore, as we saw a moment ago, fourth quarter earnings expected to be higher than they had been in a few years, and well above the 10-year average of 8.5%. So this is good news, very good news. Let's see if that's delivered. If the 11.9 is the actual growth rate, it'll mark the highest year-over-year earnings since Q4 2021, which was actually 31%. Okay, 7 sectors are predicted to report double-digit earnings growth: financials, communication services, IT, consumer utilities, and healthcare. Okay. Banks is the industry with the largest contributor to year-over-year growth. I was a bit surprised to see that, but it's looking like financials could have a big increase year on year in their earnings. So watch the banking earnings. They're typically the first ones to go. JP Morgan, Goldman Sachs, Bank of America, they tend to lead off. So you will see these reporting very soon, if you haven't already by the time you've watched this video. Okay, when it comes to IT, the semiconductor industry is the largest contributor to year-over-year growth. Again, not surprising. Semiconductors in the semi business have been booming over the last couple of years in and around AI spending. This is a really good indicator of what's happening in the economy. If the semiconductor space comes in lighter than expected in Q1, you can expect the market to sell off. Wouldn't be surprised at all. But if it comes in as expected or even better, then you can expect things to continue as they have been really over the last year. So definitely watch the semiconductor space for sure. It's going to be a big one. When it comes to consumer discretionary, Amazon is the largest contributor to year-over-year growth. Interesting stuff. And utilities, all 5 industries expected to report year-over-year growth. So utilities coming on strong as well. And in healthcare, pharmaceuticals industry is the largest contributor to year-over-year growth. So if you're looking to maybe diversify a little bit away from the IT communications sector, even though they're showing, a lot of double-digit growth in earnings, but if you're thinking it might be time to rebalance or reallocate to other sectors, then utilities, healthcare being pharmaceuticals, could be places that you could look to because they are expected to contribute to higher levels of earnings per share. Okay, and the energy, if you're looking for absolute value and you like picking down and out industries, the energy sector is expected to report the largest year-over-year earnings decline of all 11 sectors at minus 24.6%. If you're thinking long-term, you've got a positive view of the energy sector, things like oil and whatnot, then things are not looking very good for their earnings releases, but maybe you're thinking it might be a good time to buy on the cheap for a 5-10 year time horizon, something to consider. Okay. So when it comes to IT, for the 6 industries reporting year-over-year growth, semiconductors 23%, software 11%, communication equipment 8%. Okay, so we see a better breakdown. Now let's get into profit margins. Profit margins, well, what is that? Ultimately, it's just the cost that it costs a company to produce the product or the service, and then how much they can get on top of that to get the revenue. So simple example, if it costs me $60 to produce my item and I can sell it for 100, I therefore have a 40% profit margin. Okay, the wider the margin, the better, the more profits that you can get. The net profit margin at 12%. Of course, different sectors will have higher profit margins or lower profit margins. Different companies will have higher profit margins than others. Nvidia and Tesla, for example, incredibly high profit margins. Whereas some utilities or consumer staples will have much lower profit margins. But the estimated net profit margin for the S&P 500 for the fourth quarter 2024 is 12%, below the previous quarter's margin of 12.2. So only a slight downturn there, probably a rounding error more than anything. But above the year ago net profit margin of 11.3 and the 5-year of 11.6. So, although it's not a significant increase, we can see from this that profit margins are increasing and are going to come in or expected to come in higher than they have done over the last 5 years, the average being 11.6. So that's a good sign. 5 sectors are expected to report net profit margins that are above their 5-year averages, led by the IT sector, once again, 26 to 24%. So you can see IT has got much wider than the rest in terms of profit margins. 26%, the expectation for the full index is 12. So you see why investors will pour more money into these industries or into the sector of IT. Higher profit margins, higher revenue growth, and that has been what's been driving the S&P 500. Okay, earnings for the S&P 500 expected to report earnings growth of 15% for the calendar year of 2025. We saw that a moment ago. That would be very good. For Q1 2025, analysts are projecting earnings growth of 11.9 and revenue growth of 5.1. So let's see if that happens. We'll be able to watch that kind of April when companies report on Q1 2025, but 11.9% is pretty solid growth rate in earnings. Okay, the forward PE ratio is 21.4, which is higher than the 5-year average. At a sector level, IT is more highly valued at 28 times, and that's because they're growing faster and have those wider profit margins. Consumer discretionary as well at 28.2, and then the other side of the table is energy, which we saw very low valued, 13.7 times. The lowest forward 12-month PE ratio is in energy. If you're looking for value or a deep value, for example, Warren Buffett recently picked up some more shares of Occidental Petroleum, which is in the energy sector. If you're a deep value investor, energy could be a place to look. Okay, maybe with Trump coming back as well, his policies around energy, could there be an uptick in energy that no one's seeing right now, and in 12 months' time? Who knows? Something to consider. Okay. Targets and ratings. This is by analysts. So FactSet will go out, look at all the analyst projections on Wall Street and elsewhere, and they'll do a bit of a report on that. Well, the target and ratings for analysts project a 15% increase in price over the next 12 months. That's not earnings, that's in price. Price being the S&P 500. Okay, so the bottom up target price for the S&P 500 is 67.22. So how do they get to that? Well, they look at each company's earnings, calculate out the earnings per share. The earnings per share, therefore, for the S&P 500, attach a multiple to it, and you'll get your final price for the year. So the expectation for 2025, or over the next 12 months, is that the S&P 500 will go up to 6,722. It's just under 6,000 at the time of filming this video. That is around a 14.6% increase in price. That would be a fantastic year if that were to happen. It's a pretty big if, to be fair. I think it's probably likely to come in at around 8 to 10%. I'd call it 9 myself. I don't think we'll get to double digits, but if we did, that would be a very big year indeed, considering the last two have been up over 20%. Okay. So that's kind of the nuts and bolts of this report. But there are a couple of bits in the charts that I picked out that I think are really worth mentioning for sure. So I'll just scroll down, and this is one thing that I think you should really be paying attention to. Here we go. Earnings insight, geographic revenue exposure. So there's always a lot of talk that the US is overvalued. US exceptionalism in the stock market cannot continue. It's time to look at other geographical locations for your portfolio, which are better value, and get exposures outside the US. But here's something that a lot of people don't really talk about or realize. When you look at the S&P 500, which is what this chart here is talking about, the aggregate geographic revenue exposure. So only 58% of the revenue of the S&P 500 companies actually comes domestically in the United States. The other 42% comes internationally. When you stop and think about it, it totally makes sense. These companies, in many cases, are completely global. Think Amazon, Microsoft, Apple, and others. They're all over the world. They got revenues all over the world. So you're looking at a roughly 60-40 split. 60 being the US and 40 being international. So if you're thinking, oh, I need some exposures in other countries and things like that, not a bad idea necessarily. But remember, when it comes to the S&P 500, you're still getting overseas exposures by investing in those companies. For me, that's why I don't do anything outside the S&P 500. Those companies are still getting revenues. Their business plans are trying to grow outside of the US as well. Think about Apple in China, Tesla in Europe and China, for example. So for me, I don't invest in other countries for that reason, because I feel I get enough exposure with proven companies, profitable companies in the US for sure. So bear that in mind if you're thinking about diversifying at the US, or the next time you hear an analyst say it's time to get out of the US and look at other places. We'll finish it off with an EPS estimate chart, which puts it in perspective. So the bottom line here, the 239.33 that I've highlighted, that is the final expected number, earnings per share for the S&P 500 for 2024. We'll see when the earnings get released shortly in January. But the final number is expected to be around $240 per share. But look at the jump for 2025. As these companies are expected to earn more money, grow their revenues, grow their profits, grow their profit margins, the expectation for the calendar year 2025 is that the S&P 500 companies will earn around $274 per share. So there you go. If they're going to increase their earnings for the year, all else being equal, you should expect the stock market to increase. Of course, there'll be lots of noise in between. There'll be ups and downs. I wouldn't be surprised if we see more volatility than we saw in 2024. But overall, in a year's time, we can go back and visit this, and earnings should come in at around $274. Hopefully that means an increase in the S&P 500. Will we see the 15% or so analysts are projecting overall? Who knows? We'll have to wait and see. But it should be another interesting year for the S&P. That's my video. FactSet's insights on earnings. Get ready. It's about to kick off big time. You can expect the media to be on board. All the big names will be reporting. I think this is a really important earnings season myself, because valuations are high, and therefore the market can only grow really with some earnings growth. But it looks like we're going to see that. January will set the tone, I think, very nicely for 2025. Don't panic if companies come in worse. It's always worth thinking about the full year, but definitely something worth watching, I think, and paying attention to, particularly with the bigger companies, the top 10, the Mag 7 and others in the S&P 500. I hope you enjoyed the video. I really enjoy producing videos like this for people like you to enjoy and hopefully learn something. If you are finding it valuable, please like, subscribe to my channel for more videos like this, share it with a friend, leave me a comment, tell me what you think about the report, the markets for 2025, or anything else that you'd like to see on my channel. And all the best in your saving and investment journey.